You're listening to a Mint podcast brought to you by HT Smartcast.
Hello, listeners. Welcome to the latest episode of Why Not Mint Money. I'm your host, Jash Kripalani. Well, when it comes to investing, there are different investment styles which tend to behave differently during different phases of the markets. To tell us more about investment styles and its link with economic cycles and how investors should approach these concepts, today we are joined by Krishna Sanghavi, who is the CIO of Mahindra Manulife Investment Management.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Krishna, welcome to the latest episode of Why Not Mint Money. It's great to have you here. So Krishna, today we wanted to discuss with you how different investment styles can do in different phases of markets. So can you tell us a bit about that? One is, what are different investment styles and how do they fare in different cycles of the market?
Yeah, hi Josh. Thanks for having us. And actually, investment style is very interesting. Conceptually, if we track the origin of investment, it's basically in a way very simple principle. You want to buy companies, at an attractive price where it makes sense, and then sell at a higher price, which is, the traditional definition of buy low, sell high kind of thing. So that is actually the original basic investment style does not really change. Now, what has changed over time really is that there are some companies which the earning growth rate possibly can be different, can be higher, can be lower. And to that extent, sometimes the next round of investing style develop, which says that, okay, a company might be expensive, but let me buy it more because it has a higher growth rate. That's why, adjusted for the higher growth rate, I'm willing to pay a higher price. So what originally started as, as a core value investing, saying that, yes, there are companies which you buy today with the idea of or intention of making money and selling at a later date. Over a period of time, you create wealth. Somewhere, moved into this growth bucket, and somewhere after the growth, the next style developed really in the market possibly was momentum investing, where you found a lot of investors, willing to participate in a investment idea more because it was in that, momentum mode. So investing style has multiple facets. I can add quite a few more, but at the core, there is a value investing style which honestly, is capturing entire concept of investment through valuation. Then there is a growth where people are willing to put in a little bit premium to buy something today in expectation of a much faster growth rate. And the next possibly is the momentum, where clearly one is aware it is expensive, but one is still trying to play, as as the saying goes, everybody wants to dance till the party ends. So that's possibly momentum.
Right. And, we have seen these styles also behave differently in different points in market cycles. Can you talk about that?
Yeah, so I'll actually link it partly to market cycle, but essentially I'll link it more to economic cycle first. So let's look at what's happening in the world. You have a concept of GDP growth rate. Essentially, nominal GDP growth rate matters to corporate earnings slightly more than real GDP because the corporate earnings are measured in nominal terms and not really so much in real terms. So the concept is pretty simple. There is a nominal GDP, and based on the economic cycle of a particular nation, at times they are mid-single digit, perhaps low single digit nominal GDP growth rate, or more like 10-12% nominal GDP growth rate companies record. Now the beauty of that nominal GDP growth rate is somewhere it gets translated into corporate revenues and corporate earnings, etc. follow, because there is also a nice principle of operating leverage which plays out when nominal economy grows in double digits or so. on an average, corporate revenue also grow in double digit, and to that extent, when revenue growth is faster, operating leverage plays out, and companies make more profits, etc. So one of the thought process really is that in a good nominal GDP growth economy, there is nice space for both value as a style as well as growth as a style. In a low nominal GDP growth rate economy, perhaps the challenge really is that very few companies are growing. So to that extent, companies which have a faster growth rate possibly gets a far better attention among investors. But there maybe value investing does not really work if the economic growth starts going towards that low single digit nominal. Momentum, is clearly a permanent style, whether you link it to economic growth, because that's a momentum style typically plays more on the investor psyche, market cycle, rather than so much linked to economy.
Right. And Krishna, can you also explain for our listeners what are the, both risks and potential benefits of investing solely based on this investment style framework? Because we have seen in the past that value investing may underperform for longer periods and also see higher volatility. At the same time, we have seen periods when growth style might underperform. Should long-term investors looking at investment style framework when making their allocation?
So I think as far as long-term investors are concerned, with their reasonable time frame, I presume time frame we're really talking about is 3-5 years plus kind of time frame. I think those investors, as long as they are in a growth economy like India, as I mentioned, the nominal GDP growth rate honestly matters far more for corporate earnings and equity markets. So if one is in those kind of geography, I think value investing as a style has as much relevance as a growth investing as a style. The challenge really is that in a growth investing, you are trying to make your money as an investor by betting on two things. Number one, you're trying to say, here is a company, can it grow its profits as a nice double digit kind of growth rate in earnings? Second, is there something in the environment which can actually create a nice re-rating cycle, a re-rating opportunity for this particular company or this particular sector, as the case might be? In a growth style of investing, the challenge really is that the existing multiples are already high. So there, the real challenge or the choice is to say, can I make money on this company as the earning growth kicks in? And the earning growth typically can reflect in market price growth because already multiples are quite high. One challenge in growth style is that inability to figure out at a point of time where the current multiple starts coming off, because at some stage that future growth rate path starts tapering off, kind of fear. Well, you can call it growth trap, and maybe that's something one needs to be worried as an investor. So my sense is as long as the investor is agreeable to link the entire is money making cycle to the entry point investing comfort, I think value investing makes sense. From a growth style, one needs to be slightly more possibly agile as an investor to get out of those kind of styles. But my core sense really is that whether we look at value or growth, some of these styles are actually an outcome of the fact that in our mind we would have created some boxes saying this company is value, this company is growth. But the reality is the definition of value or growth essentially starts from the current valuation the company enjoys, which in a way is a function of the current stock price and the current earning potential or the current book value, depending on the underlying business one is used to. So that's where I'll put it for investors with 3 to 5 years, especially in the India kind of economy. I think there is space for value as well as growth. But value clearly offers an opportunity to have a potential for re-rating as well as earning growth.
Like you started this conversation that it essentially is about buying low and selling high, and looking and spotting investment opportunities. Essentially at the core of all of this, that's the underlying principle. And whether you can talk about it as a re-rating or talk about it as a value opportunity, quote unquote. But that's where it comes from, right? You look at opportunities that are reasonably valued or have upside potential.
Yeah, I agree. I mean, that's the essence of investing. I mean, anybody who is investing today, either as a individual investor or as a professional investor, the essence is pretty simple. You buying something today with an idea that, that purchase decision is going to make money for you over that medium to long term, with the clarity that either I'll make money because this company will keep on growing its earning rate, and or this company will have a nice re-rating potential based on the environment around its own business and maybe what the management can do to its own, future growth path.
Long-term investors who are, just looking at, taking a call, say for 10 years, 20 years, they can, I would believe, Krishna, even consider a fund like a flexi-cap fund, diversified fund, where the fund manager has a lot more flexibility. What would be your thoughts on that?
Yeah, clearly. So, when we look at diversified fund, flexi cap fund, what essentially we are discussing is, combination of two different traits. One is the essence of flexi cap being, it is flexible in its own market cap choice, market cap orientation of the fund at any point of time. But the second part, of this investing is essentially the core, which is value investing or growth investing, etc. Because having chosen the market cap to participate in by way of more of large cap or more of mid cap, as the case may be at various points of time of market cycle and economic cycle, the ultimate selection will come to company level or the stock selection, because that's what is going to create portfolio. So at that point of time, something very similar, a choice between, is this a growth investing where I'm already starting with a high multiple and my primary reason to buy is I'm expecting current multiple to stay firm and make money on the earning potential, versus a value investing where my current entry multiple is pretty much in my favor, entry is good, let me buy the company and make money on both, as long as the company delivers on its growth, on earnings, as well as make money by way of a potential re-rating based on our understanding of the environment surrounding that particular company's business model.
Right. Yeah, I agree. I mean, that's where portfolio building or portfolio creation, those things come in. So whether it's style, whether it's a cyclical basket of stocks and combined with secular basket, combined with certain sectors, and how the fund manager decides to allocate across these segments. That's where, the fund manager's ability to create a balanced portfolio comes in. Thank you, Krishna, for joining us today and sharing all those insights with our listeners. Thank you, listeners, for joining us today. If you liked this episode and would like to hear two more such interesting conversations, do log into our channel, Why Not Mint Money, on Spotify, as well as other platforms, where you will find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI, or y'all can always mail to us at mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.